Ladies and gentlemen, the 8th Indonesian Finance Association International Conference, and in conjunction with the 45th year of Indonesia Capital Market Reactivation, we will hold the event in 2 days, starting today, Wednesday, 12th of October 2022, until tomorrow, Thursday, 13th of October 2022. There will be a total of 33 papers and 4 theses being presented in the parallel sessions from 6 countries all around the world. At the end of the conference, we will present the award to the best paper and the best thesis in the closing ceremony. We also have 3 smartphones as door prizes that will be given to 3 lucky participants that stayed until the end of the conference. Please join 10 minutes before the webinar schedule to ensure that you are able to participate without any issues. Should you have any questions regarding the conference, please refer to the guidebook provided. And please fill the attendance link of each session for today's plenary sessions in order to get the conference certificate. Ladies and gentlemen, Indonesia National Anthem, Indonesia Raya. Ladies and gentlemen, welcome to the 8th Indonesian Finance Association International Conference. We would like to welcome the Honorable Chairman of the Board of Commissioners of Indonesia Financial Services Authority, represented by Head of Digital Finance Innovation Group of Indonesia Financial Services Authority, Mr. Triyono. We also would like to welcome Founding Editor of Pacific Basin Finance Journal, University of Hawaii, Professor Gonri, Associate Professor in Southampton Business School, University of Southampton, Dr. Renata Kizis, BA, MA, MSc, PhD, FHEA. Professor in Accounting and Finance, the University of Western Australia, Professor Dirk Boer, MSc, PhD. Chair of Advisory Board, Indonesian Finance Association, Professor Eduardo Standalilin. President of Indonesian Finance Association, Professor Irwan Adi Ekaputra. President Director of Indonesia Stock Exchange, Mr. Iman Rahman, Board of Commissioners and Directors of Self-Regulatory Organizations, stakeholders in the capital market, all of the invited deans, lecturers, students, and academics. Thank you for joining virtually. We could not be more grateful for the spirit of the participants in this year's conference. Although we could not meet in person for this event, we are sure all of you will still benefit and gain knowledge from the conference. We also hope that it will still enhance Indonesian financial scholars' contributions to the international academic landscape and participation in advancing the financial literacy as well as policy making in Indonesia. Ladies and gentlemen, We will start today's event by opening remarks delivered by IFA President. Please welcome Professor Irwan Adi Ekaputra.
Thank you, Ibu Yolanda. Thank you, Ibu Yolanda. Assalamualaikum, salam sejahtera, Om Swastiastu, Namo Buddhaya, salam kebajikan. Very good morning to all of us. Welcome to the 8th Indonesia Finance Association International Conference in conjunction with the 45th anniversary of the Indonesia capital market. First of all, I would like to thank all of the participants for the participation in this international conference. In particular, I warmly welcome and thank the distinguished Chairman of the Board of Commissioners of the Financial Services Authority, or OJK, represented by Bapak Triyono Gani as the Group Head of Digital Finance Innovation of OJK. Please allow me to kindly greet and express my gratitude to distinguished President Director of IDX, Bapak Iman Rahman, IDX Board of Directors and Commissioners, distinguished President Director of KPI or ID Clear, Bapak Iding Pardi, ID Clear Board of Directors and Commissioners, distinguished President Director of Indonesia Central Securities Depository, Bapak Urip Budi Prasetyo, and KSEI Board of Directors and Commissioners. This event will not be possible without their relentless support. Thank you also to distinguished guest speakers, Professor X. Gonri from the University of Hawaii at Manoa, Professor Renata Skizis from the University of Southampton, Professor Dirk Bauk from the University of Western Australia, Irbu Irmawati, Head of Business Incubation Division from the IDX. Ladies, gentlemen, and distinguished guests, please allow me to briefly introduce the IFA. The IFA is aimed at improving the quality and quantity of research by the Indonesian scholars and practitioners in finance and banking. Moreover, the IFA yearns to contribute to research-based policy recommendations to financial regulators in Indonesia. IFA missions are enhancing Indonesia financial scholars' contribution to the international academic landscape and also to participate in advancing the financial literacy and policies in Indonesia. This year's conference theme is Capital Market and Securities Digital Transformation, the Future and Challenges of Digital Assets. As the theme suggests, we need to learn and predict the impact of digital transformation on financial intermediation, capital market, and financial investment decisions. Some predict that financial intermediation will likely be easier in this transformative era. We also understand that Indonesia is the largest archipelagic country, so digitalization and fintech will provide an opportunity to improve financial inclusion, operational efficiency, and cost reductions that will hopefully benefit market participants and the country as a whole. There is a higher appetite for advanced analytics, cloud, AI, and blockchain. We are observing the rise of algorithms in our everyday lives, including in the capital market trading activities. Nowadays, investors have options to invest in digital financial assets in addition to conventional assets that we are already familiar with. The external literature suggests that investors may utilize some types of digital currencies as diversifier, hedger, or safe haven against traditional assets such as stocks and bonds. In this digital era in fintech, regulators and SROs will also face persistent challenges in regulation to keep up with the unavoidable changes. There is also an increasing need for improved cybersecurity and compliance procedures. As part of the regulatory responses, I know that just 2 days ago, OJK has launched some initiatives such as customer support chatbot technology, digital financial literacy module, and capacity building program. Perhaps we can learn more about this from Bapak Triyono Gani as the OJK's Group Head of the Digital Finance Innovation. To end my remark, I would like to take this opportunity to congratulate and thank Professor Eduardo Sandlin and steering committee members of the IFA, the Joint Organizing Committee led by Dr. Leo Indrawardana, conference presenters, participants, distinguished guests, and all of our partners for their continuing support to the IFA. As already mentioned, this year we have 33 presenters from 6 countries and well over 675 registered participants. A tremendous success that I would like to applaud. The conference will run for 2 days, today and tomorrow. So please take the opportunity to learn from our distinguished speakers, academic leaders, and practitioners to make your advancement in this digital era. Thank you for your kind attention and have a fruitful conference. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you, Prof. Irwan Adi Eka Putra. Next is speech by President Director of Indonesia Stock Exchange, Mr. Iman Rahman. The time is yours.
Thank you, Yolanda. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Good morning. Greetings to all of us, the Honorable Chairman of the Board of Commissioners of the Financial Services Authority, represented by Mr. Triyono Gani, Head of Digital Finance Innovation Group, OJK, President of IFA, Bapak Profesor Dr. Irwan Adi Eka Putra, Founding Editor of the Pacific Basin Journal of Finance, University of Hawaii, Professor Gondry, Associate Professor of Southampton Business School, University of Southampton, UK, Dr. Renata Skizis, Commissioners and Directors of SRO, including but not limited to Commissioner of IDX and colleague of Director of IDX, President Director of KPE, Bapak Idin Pardi, and colleagues of Director of KPE, and also President Commissioners of KPE, the President Director of KSE, Bapak Uri Prastyo, including also President Commissioner of the KSE, Bapak Fuad Rahmani, Ibu Dian, and also Pak Indra, distinguished guests, participants, ladies and gentlemen. First of all, I would like to thank the Financial Association Indonesia for its cooperation with IDX, KPE, and KSE to hold this year of IFA International Conference with the theme of Capital Market and Securities Digital Transformations, the Future and Challenges of Digital Assets. This is the third time we organize this event, and we are pleased to see how it has attracted enthusiasm of many people who are keen to share their knowledge and research related to finance and capital markets. Ladies and gentlemen, for the last few years, we've experienced a rapid transformation of digital and technologies in all sectors, including in financial markets. The advancement of financial technologies has brought innovations that provide financial services that are not limited by country or state borders. These innovations include the presence of digital assets. Digital assets ecosystem has developed significantly since the advance of Bitcoin over a decade ago. Cryptocurrencies and blockchains technology has a revolutionizing impact on financial services, including capital markets. In Indonesia, digital assets have become a trend. The ownership of cryptocurrency has increased 2.66% in year 2020 to 4.5% in 2021. The majority owners of the cryptocurrency in Indonesia are millennials, and according to Indonesia Ministry of Finance, the number of crypto markets compared to the capital market is 15.1 million to 9.1 million investors, even though the trading value of capital markets are bigger than in the crypto markets. In certain ways, digital assets have eliminated unnecessary restriction, leading to inefficiencies regarding the free allocation of capital and seem very attractive to investors. However, they also have a set of challenges that we need to be aware of. So it will be interesting to see from many points of view that opportunities and challenges of digital assets and how they impacted the capital markets and securities digital transformation in the future. On this opportunity, I would like to thank all the speakers, participants, and everybody who have supported this event. I hope this conference can provide meaningful discussions and new insight that will be beneficial for the capital market and economic recovery in Indonesia. Ladies and gentlemen, once again, welcome to the series of IFA International Conference. I hope you enjoy and be inspired with discussions. Stay safe and healthy, and have a great day. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you, Mr. Iman Rahman. The event continues with keynote presentation and opening of the conference by Chairman of the Board of Commissioners, Indonesia Financial Services Authority, represented by Head of Digital Finance Innovation Group, Indonesia Financial Services Authority. Please welcome Mr. Triyono.
Thank you very much. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera bagi kita semua. Om Swastiastu, Namo Buddhaya, Salam Kebajikan. First of all, I would like to greet the chairman of Indonesia Stock Exchange, Pak Iman Rahman, and I think we have also noticed the attendance of our senior practitioners in capital markets and also the policymakers as well. And certainly all the panelists that would be delivering and also guide some discussions later on. And all the participants that have attended this very prestigious event. Thank you very much for inviting OJK to this very prestigious event, the so-called 8th Indonesian Finance Association International Conference. I think this is very high level event and in conjunction with the Indonesia capital market, other Indonesia capital market events. So I think, first of all, I would like to thank you for the invitation to OJK. And firstly, I would also deliver the message from the Board of Commissioners, since today is Wednesday. Wednesday is Board Commissioners meeting, and it will be very difficult for our chairman to deliver a speech, and has assigned myself to represent OJK, and hopefully it could fulfill your standard and also can answer all the questions that you might raise later on. The topic that would be presented in this event is very, very interesting, because I think it is not only related with this current development of capital market, but would be then more to do with the future of capital market. Hopefully the connection will be quite good, and my voice could be heard clearly, and all the things that I would deliver later on will be received very easily. Okay, I have, in terms of this keynote speech, I have a presentation to make. Maybe I would like to go through some slides and guided by the slides. Hopefully it could manage the presentation much more systematically, so it will be then giving the maximum benefit to you, all the participants. Okay, first of all, I think the digitalization, go to first slide, please. So the digitalization, I guess, this is very obvious phenomenon that is happening right now. And we are going to talk about four key points. And as the head of Digital Financial Innovation Group in OJK, I'm dealing with not only capital market, but also some other industries. But definitely the development in capital market is much more advanced comparing to the other sectors. If you may also aware that the most popular financial technology, even though this is probably a little bit infamous, but I think regardless all the things that's happening in the market, but the benefit of P2P lending, for example, has been widespread acceptance. So I think in terms of fintech, almost all the digital finance activists know about the P2P lending. But in terms of advancements, I guess, because the technology that lead to some new development in terms of transaction and also the technology adoption, capital market is a little bit leading comparing to some other areas, maybe followed by the banking sector. Because I think we are aware that robot trading, for example, or the digital trading platform has been in the market long before the appearance of digital banking, for example. So I think in terms of advancement, again, capital market is leading comparing to some other financial sector. So the four things that I would like to talk about this morning, we are going to talk about the digital economy outlook and the ecosystem. I think this is very important to overcome all the challenges that we are facing right now. And then the second topic would be our roles in managing the digital transformation sector, and then what is really specific to the capital market. And lastly, we are going to talk about the challenges occurring in the market. So firstly, when we see the digital economic outlook, I think everyone would be agreed on these figures. We are going to be a very big GDP generated. I think if we talk about the scale of economy in Indonesia would be huge. We can see that the number with the distribution of the digital economy. We can see the number of digital economies around 4,500 trillion, which is contributed by mostly the e-commerce, 1,900 trillion. And as you probably also aware that e-commerce is the real engine of the digital economy, because according to my experience and also knowledge, e-commerce is the terminal of all the digital transactions. You can find almost every single digital financial transaction in the e-commerce. You can find certainly the goods that you are looking for, and then you can also find some opportunities in buying insurance, or maybe in buying investment products as well. So I think e-commerce would be the one-stop shopping point, and that everyone can join, and also it's a very good window for entering the financial sector. So we have four main takeaways. The first will be consumers cruise into a new way of life. I think we are going to talk about how pandemic changing the behavior of customers, and this is also really, I think, relevant to myself as well, because I didn't get used to use the digital platform to buy things, but now I'm depending on e-commerce very much, because once I tried the e-commerce platform, I find some easiness and also benefits that I would get by using the e-commerce. So basically, the main drivers of this digital economy, the upcoming digital economy, will be the changing of customers' behavior and way of life. And then the second would be how the adoption of the merchant that has been capturing this opportunity as well. So I remember when I think when the first stage of pandemic, COVID-19 pandemic in Indonesia, the government then suggests all the merchants to use non-cash payment, for example. I think this is also a very big push to the adoption of the digital payments, also including how then fintech can get into, and how technology can get into the easiness of payment systems. And then the takeaways. The riskiness of gives away resurgence. I think this is also very, very important, since the changing of Indonesian customer behavior, and supported by the technology, certainly, and also the adoption from the players, would end up with the volume of traded goods in the platform. So I think, again, this is a very, very obvious facts that you are facing. And then we can see that the GMP value in Indonesia reached $17 billion. I think this is quite a good number, and I believe that it will be still increasing in the future, and up 49% year-on-year by, and it also is in the future. So I think this is very, very astonishing number. And then the last takeaways that I could share is the funding track of to reach the new highs. I think investment would also be rebound in the first half of 2021. So I think this is also relevant to the current situation. And we believe that in OJK, because we are still developing the ecosystem of digital financial sector, we could not let alone the development of financial aspects. Financial is very, very important. Otherwise, all the startups would not, growing rapidly, and also it cannot get the market efficient very easily. So the market acceptance would be then supported by, it should be supported by the proper financial support. Next slide, please. So the next slide would be the thing that I just mentioned previously about how the customer change their behavior. I don't have to go through all the figures, but in short, I can say that customer more acquaintance with the adoption of digital finance sector, also all the digital economy activities. And not to mention about so many products that are offered in the market, and we also see the possible future adoption, much more advancement in financial sector. Referring to my previous statement when I said that the adoption of technology in the capital market is much more advanced comparing to the financial sector. So the last comer would be from the insurance sector. I think this is also very important because the insurance also now embracing the technology. I can mention some insurtech cases, for example, and it would be then combined with some investment products. I think this is very obvious phenomenon that we are going to face in the near future. Next slide, please. Next slide, please. I haven't seen the change in my slide. Okay. Just to emphasize what we are now discussing about the digitalization of financial sector. So the main challenge that come into our jurisdiction in terms of financial service authority, we are now faced by, we are faced by the phenomena whereby the financial service providers is not really the financial institution. So I think this is also aligned with the market development, where we can see that the transportation, for example, a company or the transportation platform, it is not really the transportation company. So this is aligned with what is happening in the financial sector. We see now that the financial service providers is not necessarily the financial institution. So we have to determine how can we then overcome this problem. And we still should adopt the phenomenon of the market. And we cannot really avoid this thing to be happening in the market because it is not the problem of Indonesia authority alone, because this is also experienced by some authorities as well. So you can see that, I'm sorry, the definition of digital economy. We can see from some other research in this case, the ADB also mentioning about the phenomena of what is happening in some other countries. ADB and also Deloitte is well recognized worldwide institution. So it is also reflecting what is happening in some other countries. It means that we can also learn from some other countries how to handle this situation, because, you know, this is not the only problem of Indonesia, but this is a problem of worldwide. Even though there's also very obvious that everyone in this world is really studying and also waiting for what is happening. So everyone is in wait and see mode. And of course, in OJK itself, we cannot really, have this position as long as we can have. I mean, we have to really move forward, because it is not possible to stop the market development. That's for sure, because, you know, if we see that something is coming into our market, the option would be two things. The first would be how we can embrace that development. And the second is how can, if possible, escape from that development. I think those two options would be that coming into our discretion or our policy research. But still, we cannot really ignore 100%, because the phenomenon of the market is very, very important, and we believe that we should do something with this upcoming phenomena in the market. That's why we then got into the the first option, that we embrace the development of the technology, and then we define what sort of actions that and policies we should take. And then from the next slide, please. We are not the only institution that care about the development in technology, and according to the authorities that we have, JKA, at least in terms of sectors that we are now handling, we have at least three things that we would be very, very careful taking care of, and then at least the thing that we have already issued the regulation. The first, we have issued the P2P lending regulation. This is the lending side, and also the digital finance. This is also what we call the innovations or innovators in the financial sector, and the third regulation will be securities crowdfunding. Maybe I can also add one more point in this case. I would say that the banking sector also is doing the digital banking regulation as well. So OJK in this case has more in terms of or has a broader authorities in handling the financial sector, digital financial sector, because some other sectors then will be handled by some other institution. We can see that Bank Indonesia is also in charge in terms of digital payments and other activities related with the payment system. But the digital activities sometimes also correlated not only with one sector, but would be more omni-channel or omni-services, and it will be then related with some other financial sector as well. I mean, in this case, we can see that in terms of crowdfunding, for example, crowdfunding we can divide into three things. The first will be the investment crowdfunding. We have already handled this, and then the second would be the loan crowdfunding. We have already also issued regulation on this, and the third kind of crowdfunding would be the social crowdfunding. I think this is the thing that beyond our authority, because it will be fall under the Ministry of Social Welfare. So this is only one case whereby showing the intertwined situation between one authorities to the other authorities. And the key things that we are facing now is how to cooperate and also communicate amongst the authorities to formulate a very effective policy that can cope with this interlinkage activities. And the thing that is also would be a very big homework to us is, for example, if we are handling the multi-platform or the super apps, for example. So this is also the possible use case that is coming into our market, because this super app would be very, very closely related with not only one sector, but also would be more than one sector involved in that kind of activities. Next, please. Before I continue, I would like to confirm to the MC, Ibu Tandia, how much time that I have. 30 minutes. Okay, all right. Okay, let's move on to the second topic that I would like to deliver. About the response of OJK in terms of digital financial sector. So, as I mentioned before, that we are facing a very huge challenge in terms of embracing this digital transformation in Indonesia. And I also mentioned that we are not the only authorities that are facing this problem. And I also spoke to some colleagues in ASEAN, colleagues in Asia Pacific. They are still looking for the best setting where they can also cope with this development of digitalization very carefully. So at least I can note 5 points that we are facing in this market. This is also not only related, maybe in terms of ASEAN, probably some countries are also suffering the same problems, but some are not. For example, in Singapore, which is much more advanced compared to us. So it will be then typical to developing countries, developers. But I can also share to you that Indonesia fintech currently is the much more advanced fintech compared to some other ASEAN financial sector. I also pay this compliment to the capital market as well. I believe that Indonesia capital market is much more advanced comparing to the other colleagues in the region. So the first problem would be the low level of financial literacy. I can maybe say that this problem is a double-edged sword, probably, because we can see from both sides, right? The first side will be from the threat side. I mean, this is very scary because if we are the illiterate customer, then we are entering the much more advanced market, in this case, the digital financial sector. So the risk will be very, very high. Since we don't understand what is the risk and we don't understand how to cope with, how to mitigate those risks. So we can imagine that the problem would be huge, and our challenge basically is try to bring up or leveling up the level of literacy, so that all the customers that is going to use the digital financial services would have proper knowledge and also can mitigate those risks and increase their security. But in the second side, probably we can see that this is the opportunity. Why? Because since the low level of financial literacy means that probably the adoption of digital financial active services is still also low. If we are smart enough to use this opportunity, we can see that there will be the huge chunks of market that can be penetrate. So I think this is a very, very good opportunity if we see and also you find and can identify the best needs that they're lying in the market. The second challenge would be the cybersecurity risk. I think, again, we have already seen from the news lately, currently about how hackers can get into the governmental institutions' data, for example. I think this is very important, but this is not only the problem of certain parties, but this is the problem of all parties that are dealing with the financial sector. We try our best to cope with these cybersecurity issues, and hopefully by issuing some or the issuance of the personal data protection law, it could increase the awareness of how important the data keeping in Indonesia. Because previously, I think that the problem of Indonesian market or all the parties involved in digital financial or maybe in regular activities as well. So we are lacking about the awareness of keeping the personal data. It seems that the personal data is not previous enough to be kept and also to be managed. But once we have this personal data protection law, everyone then can now see how important to keep the secrecy of the personal data. And then the third point would be the regulation is not that adaptive. This is very true. Sometimes when I receive some proposals from the market about the new use case, it is not 100% comply with the current regulation, or it is completely different with the current regulation. It is not even 100% fall into or maybe comply with the banking law, for example. It is not 100% comply with the capital market law or in the insurance law. So it was in between. And sometimes this is a very, very huge homework as well for us, because we should determine who should handle this particular use case. But I think this is quite obvious that those activities should not really, supervise using this existing regulation, because we can also draft the new regulation, for example, for the P2P lending and securities crowdfunding. I think this is very clear example where OJK is very open-minded and also very flexible in drafting the regulation. Since we see that those phenomena is in the market, we are not hesitate to draft new regulation. We are very adaptive to the market. And the fourth point would be lack of qualified community human resources. And this is not only in the market, but also in the financial service authority as well. We have some programs where we can then increase the capacity of our supervisors in application of the supervisory technology. So we are really dynamic enough in terms of capacity building in OJK to adapt with the new development of supervisory technology. And I believe that in terms of the market as well, I spoke to Microsoft yesterday, and they also have a very good certification programs and also offering those programs to regular public. So I think it will increase the supply of capable personnel in terms of digitalization. So the last thing that I see that the problem will be the big data. Big data and also the cloud would be a very, very huge benefit that I could see. Because, previously the concept of data would be just to be, for the sake of accounting or something like that. So we don't really get the benefit from the data, or maybe we cannot monetize the data. But now, with the upcoming technology, we can really expand the use of the data. And so this is very important issues as well. But to develop very robust and also very good data lake is not really easy. We can see that we have gone through all the activities which is not very traditional, paper-based activities, for example, but it is not possible directly to convert from those manual activities into fully data friendly activities. So I think at least from this point until I think in the future, so we are realizing that from now on we should record every single thing, and also we could take benefit from what we are doing, because everyone believe that the track record or the data record would be very, very beneficial for us in the future. And this is also recognized by the financial sector. As I mentioned before, that the super apps is using the benefit of big data, since for example, if one financial conglomerates consist of banking sector and also insurance and capital market as well. So they can then comprise, or maybe they can analyze cross-sectoral activities for one particular customers and develop a very robust customer model in terms of data check record that they have. Or maybe they can also link with the real sector as well, the non-financial sector. And they can make a very good pattern and also customer behavior pattern so that they can maximize the strategy of marketing. So I think this is an obvious phenomenon that is happening in the Indonesian market right now. Next slide, please. So in terms of OJK, we have already developed the financial sector master plan, and we recognize those importance of the digital financial sector and also the digitalization happening in our financial sector. That's why we put the third pillar of accelerating digital transformation. So we are not, you can see that we use the word of accelerating. It means that this is not this regular transformation, but this is the accelerated transformation. Why? Because we see that in the market, they are also accelerating in the speed of development, in the speed of transformation. So we have to follow, the infrastructure have to follow, because otherwise it will be then back behind. And if we don't really have the same speed as the market development, certainly it will create some problems because the infrastructure is not supportive and also the regulation is not supportive. So there will be a chaotic situation in the market. So that's why we are now committing the accelerated process in terms of transformation. Next slide, please. Okay, how we responding this phenomenon? The first would be certainly since our main task is regulation and also this supervision. So using our sandbox activities, we diligently learn about what is really happening in the market. And from that findings, we can see the opportunity to drafting new regulations, or maybe expanding the new regulation, or just stand still. I mean, it is very obvious, or maybe we still have the chance to do nothing with the technological development, because sometimes it is not really accepted by the market yet. I mean, the customer is not really accepting those new keys. But if the acceptance of the market has been quite strong, so we don't have any option other than developing new regulation, or maybe expanding the new or the existing regulation. So in short, I can say that considering all the risks, including the risk management, IT, cyber risk, and things, and certainly giving the benefit to the market, we do not hesitate to draft necessary regulation, which is really in terms of supporting the market development. And the second strategy that we are now implementing is how we can apply the supervisory technology and regulated technology. RegTech is also very important because it can help us to increase the effectiveness of supervision. Why? Because the automation of risk management, for example, it can create efficiency not only in the financial institution, but also for us in terms of financial supervisors. Once we really see that the reliability of the system that is used by the financial institution in terms of risk management automation, so we can then sit back and relax. I mean, this is not the real term that I use, but at least we can rely on a certain system that can support us. in terms of increasing the first line of defense. Definitely, we should develop still the second or the third line of defense, but at least we have already system in place that can increase the effectiveness of the first line of defense by application of very robust regulatory technology. And then the third strategy that we are now adopting is the initiative of data integration, data warehouse, and data development. I cannot say that this is a very easy task to do because we are all aware that the level of advancement in financial sector is not the same. I mentioned that probably the capital market will be the first or the highest in terms of data technology, but we cannot really leave some other sectors behind. For example, if we talk about the product that link between insurance and also the investment, so it is very, very obvious that we should make sure that the data management in insurance sector is as advanced as capital market. Otherwise, it would be a very huge gaps and also create some problems as well, because it is also proven by this the thing that is happening in the market. So our job is try to at least increase or maybe making all the same standard applying to all the sectors at least. And I believe that it is very, very easy to do because the price of technology is not that high comparing to maybe 5 years ago. So we can see that the shared economy, how can we then embrace the collaboration with fintech would be one example strategy that can decrease the cost of operation adopting technology. Next, please. Okay, this part I would like to talk about the capital market, digital financial innovation in capital market. Next, please. So at least I have three groups in terms of capital markets development or the digitalization of capital market. First would be the securities crowdfunding. The second group would be how we expedite the process of licensing process using sprint and IPO also. We can convert from manual into much more advanced. And e-voting is also very very good tools that can run all the process of voting clearly and also very quickly, regardless of the presence of the shareholders. And then the third group would be the utilization of capital market itself and using the technology. So next, please. And then we can also highlight the benefits of using the securities crowdfunding platform to support the MSME. We believe that relating to the Indonesian economic profile, whereby the number of MSME is still dominating the market. So I believe that it would be then give much more benefit to the society. That's why we expand our regulation. Previously on the equity crowdfunding, now we are expanding into more broader scope. That we also adopt the security crowdfunding regulation. So I can say that we are not probably the only country that is embracing this use case, but I believe that in ASEAN at least there are only few countries that are drafting the regulation for securities crowdfunding. But this is very good sign where to show to the world that Indonesian advancements in terms of capital market is quite good comparing to some other countries. And I believe that the acceptance of the market as well is also very, very good. And some of the players and also the traders is also quite active in terms of their trading activities. So I think, again, this is showing how beneficial this use case to the development of MSME. The problem will be that how to increase the supervision, because I believe that every single thing that is has been in the market, so it should be then not only properly regulated but properly supervised. There are so many ways and negative aspect that can be happening if we don't really apply a proper supervision in the market. Next, please.
Mr. Triyono, you still have 15 minutes left in your presentation.
Excuse me?
You still have 15 minutes left in your presentation.
Thank you very much. Thank you. Okay. The next would be the information on the subtech of infrastructure and capital market. This is more to do with our internal process. So I also sharing with you all that we are now adjusting our speed of supervision and also our quality of supervision. Otherwise, we are going to be lag behind, and the quality of supervision will be less, or in terms of quality compared to the market advancement. So at least I can divide into 5 groups. The first will be the process advancement. We have sprint for the e-licensing, integrated licensing. And then the second will be Securities, the integrated financial services integration. So I think this more to do with the reporting system. And then the second group would be the supervisory duties, the capital market, the SIP-M, capital market supervised for information system, and then SEPT, the independent information supervision. So I think this is increasing our capacity to supervise in terms of collecting the data, because as you probably also aware that it is also impossible for our supervised activities if we don't really collect the data properly. And then the third group will be try to expedite the licensing process using the electronic signature. This is very important issues as well. We have just launched the initiative of building the trust system in the financial sector, where the electronic signature is very important component in terms of building the trust system in the digital financial sector. The fourth group will be the decision support system. So I think, again, this is very important, how to assist the supervisor to make the decision. And then the data warehouse also very, very critical in the last development of our supervising capacity. And then the fifth group would be more to do with reporting, and we connect with not only internal OJK in terms of intersectoral data sharing in OJK, but also we connect with third parties in terms of financial sector and also some other parties as well. So hopefully by interconnection, we can get and also bring more benefit and also the synergy to the whole financial sector supervision in capital market especially. Next, please. We have future plan for capital market digital transformation. The first will be try to strengthen exception reports as early warning system function. So I think it is very important because early warning is much more effective, because we have the terminology of making a very fast policy or reaction. The policy reaction should be as timely as possible. And it is very impossible if we don't do the proper early warning system. And then the second would be using our subtech program. We try to utilize our big data in the market industry. I think we are now developing one prototype, but still in the banking sector. Hopefully, there will be coming use case using the capital market data. And then the third initiative would be how to develop extensive business reporting. So again, talking about the supervision, it is very impossible if we don't talk about the effective reporting and the system that can talk to each other using the same language in terms of reporting system. And then next initiative is utilizing technology for IPOs and debt or sukuk. I think this is also very important. And I don't know whether we can use also the blockchain system in terms of sukuk trading or securities IPOs, that kind of things. But still, it is very open opportunity for us to develop the technology and also embrace what kind of technology is the most proper thing to use in our financial supervisory process. And lastly, we are strengthening our regulation on mutual fund securities. This is also a thing that I also mentioned. The interlinkage between the capital market and also some other sectors is very important. And the enhancements of mutual fund regulations and also the system they can give, again, the early warning system. It is also very, very important. Next, please. So this is my last part of presentation. Hopefully I can meet the time limit. Next, please. So we can, in the future, if we can divide into two things. The first will be customer and industry side, and the second will be regulatory side. So this, along with my statement previously about the supervisory technology and also the regulatory technology. As the regulator, we don't think that we are, excluded from the market, but we should be in the market. So we should see the development of the market carefully, and also we adjust necessary things that we should do using our own capacity. But now I would like to say that we are drafting the regulation on the innovation in the financial sector, so that can bring more clearance in terms of division of authority, for example, between BI and also OJK, and also what sort of authorities that will be given to us as the financial authority. This is very important, including the activities in the capital market as well. But from the customer industry side, I think since the digital financial literacy index is still very low, around 26%. So this is a very huge homework, as I mentioned before, not only for OJK, but for all of us. And this is not concern of authorities, but also concern of everyone. And I also mentioned that this low digital financial literacy level would create risk as well in terms of adoption of financial products. One illiterate person can easily buy unnecessary products, or maybe buy very risky products without considering how much risk that they actually accept. It should be then very, very carefully done with all the risk assessment and also risk mitigation. And again, we also urge or maybe ask our financial institution under OJK supervision to be actively educate the customer. So please do not put the sales target as the first goal, but the ultimate goal should be protecting the customer. So this is very important because otherwise we could maybe sell one product which is improper to particular customer, for example. So mis-selling, the thing that I always mention, is very, very dangerous and also would be harmful to the financial stability as a whole. Next, please. Okay, the customer protection in digital era is very unique things that is happening because currently we are not talking about very small transaction but very big tickets. We are talking about very big amount of transactions with small tickets. I can give one simple example. Everyone can afford to buy mutual funds, for example, because previously when I just graduated from school, the price of mutual fund is very, very expensive. But now everyone can afford to buy it. But again, it will create a huge amount of transactions, and certainly since the number of participants increase very much in the digital financial activities, it will create a number of huge complaints to us. This is the thing that also relating to our supervisory system, and it is very impossible if we can impose using or maybe analyze using the manual tools. It is very impossible. So we have to have a very advanced system that can afford to analyze this huge amount of data that come into our supervisory system. And the other side is that the startups is very small and also early born business. That's why our president gave the direction to OJK that we should apply light touch and safe harbor approach. I think this is very good approach that we should apply to the industry, because otherwise it will kill the industry very, very easily. And in consequences, the number of innovation would be decreased, and certainly the thing that is harmful to the Indonesian level of competitiveness. So I think this is very important. Next, please. And this is the thing that we are talking about, the subtech and direct. I think this is only maybe as knowledge to all the participants that we have at least 5 initiatives to develop subtech and also 5 initiatives to develop RegTech. Maybe the thing that I would say in this slide is that subtech and RegTech is a very, very intertwined process, and also should come in the same pace or in the same speed, because otherwise it will create gaps. And also one problem will be occurred in the market, whereby the quality of supervision will be then be sacrificed, or maybe the customer protection will be then in trouble. So I think this is very technical issues that we would like to discuss, but I think I would then give a very short impression on this slide. Next, please. And how to overcome the challenges. I think this is also, again, the thing that we always think about to embrace the new technology coming into our market. The first is certainly we would like to say to be very grateful for this recently issued law of data protection, And the second would be, as I mentioned before, we are now drafting the financial sector omnibus law, and hopefully it can create a very strong foundation in terms of legal framework to all the innovations that come into the market. Next, please. And as the regulator, we cannot really, stand still. We are now seeing the future. We see the potential problems or potential threat or potential opportunity that will be used by our colleagues in financial sector. They are beginning to think about how to apply the Web 3.0, how to apply the metaverse, and what decentralized finance can bring a benefit to the business. So I think, regardless all the plus and minus for the pros and cons, we are still studying all the possible use case and how to formulate the proper supervisory strategy to cope with those new advancements. Next, please. And this is the also thing that I also mentioned before about the robo-advisor. I think this is very relevant to what is really happening in the capital market. So everyone agrees to the benefit of robo-advisors. It can really create assistance and also tools that is very powerful for our investment decisions. Easy, fast, and very reliable, or maybe comprehensive as well, and intelligent for sure. But we have to really be careful on adopting these robo-advisors, because there are some drawbacks in the robo-advisor adoption, because the algorithm is very, very critical, because sometimes the fraud can happen in terms of drafting all the algorithm, and not to mention about the ethical issues in terms of drafting the algorithm. So I'm thinking to really see the guidance for drafting the algorithm as our highest priority in terms of giving the certainty to the market, and also increasing the customer protection effort when they are using the robo-advisors. Next, please. Talking about the decentralized finance that I mentioned in the previous slides, we see that it is also very, very possible to face or to receive the ideas of tokenized trading, the securities trading platform. And maybe if we see the current regulatory setting in terms of digital assets, we are only talking about the cryptocurrencies as the commodity. But I believe that by seeing the opportunity and also the possibility that is coming into our market, so the tokenization is very, very huge, giving a very huge push, huge push to us. And we believe that we should embrace these issues very soon. And I believe that we can get some, or we are going to face a new kind of securities, or new kind of market activities using this tokenization of securities. Maybe this is only the one possibility comparing to few more possibilities using the tokenization. And decentralized finance certainly giving positive and also negative. But I believe that we should have a very, very proper policy to embrace those upcoming technology into our market. Again, next, please. So this is only showing you the big push or big influence of tokenization. It is not only possible opportunity, but also probably possible risk. We should recognize both, because in terms of drafting the regulations, OJK always or always put the risk management or risk mitigation in the first place. We cannot really issue the regulation without knowing the proper, or maybe knowing or identifying the proper risk, because the purpose of regulation is certainly try to limit and also to mitigate risk, not to really escalating or boosting the risk, not to advocate risk, but try to minimize the risk. And this is for sure in relation with customer protection. And in short, I would like to say that blockchain technology and decentralized finance is coming, and I believe we have to stand ready to face this upcoming development, and drafting also, formulating what kind of strategy which is very proper to cope with those upcoming development. I think this is my last slide. Ibu Tantia and everyone, thank you for hearing my speech, and hopefully this can also give you some ideas or informations what is really happening in OJK and also in the market, and hopefully it can also give some views on what will be happening in the future as well. So again, thank you so very much, and I would like to say that if there are some accuracy in numbers or information, please forgive me, and I believe that we can have a further discussion if necessary. Thank you so very much. Assalamualaikum warahmatullahi wabarakatuh. Over to you. Thank you very much.
Thank you, Mr. Triano. The 8th Indonesian Finance Association International Conference is officially opened by Indonesia Financial Services Authority. Now we will have a photo session together with all the invited speakers and also guests. Mr. Triano, please kindly stay in the room because we're going to have a photo session. Please position yourself in front of the camera and give your best smile. We're going to have several photo sessions first. Okay. Everyone, please be ready and position yourself in front of the camera. Okay, I'm gonna count 1, 2, 3. 1, 2, 3. 1, 2, 3. Okay. Thank you, ladies and gentlemen. Next, we will begin the plenary session presented by founding editor of Pacific Basin Finance Journal, University of Hawaii, Professor Gonri. And please welcome the moderator for the plenary session, Head of Doctoral Program, Faculty of Economics and Business, Universitas Gadjah Mada, Professor Dr. Mamduh Mamada Hanafi, MBA.
Thank you, Bu Tanti. Assalamualaikum warahmatullahi wabarakatuh. Good morning, everyone. Good morning, ladies and gentlemen. For the next session, we will have presentation from Professor Gonri, and I'm happy to chair the session. Professor Ri was my dissertation supervisor when I did my PhD at the University of Rhode Island. Later he moved to University of Hawaii So it's good to see you again here, Professor Lee. So before we move to the session, let me introduce Professor Lee. I have a short bio, so let me read it quickly. Professor Conry graduated from his BA from College of Law, Seoul National University, and then he received his MBA from Rutgers University, and then he received his PhD in finance from graduate school, the Ohio State University. Currently, he is the KJ Luke Distinguished Professor of International Banking and Finance, Seidler College of Business, University of Hawaii. And then he's also associated with several universities, such as National Central University, Taiwan, Dongbei University of Finance and Economics, as a visiting professor. Professor Lee is also founding editor of the Pacific Basin Finance Journal, and he has published numerous papers in top journals. Okay. Professor, we're going to have a 60-minute session. So probably let me propose around 30 minutes for the presentation, and then another 30 minutes for the QA session. Okay. If that is okay, then let's do it.
So I can speak now?
Yeah, okay. So please welcome Professor Lee. Please, stage is yours, please.
Thank you, Mamdu. It's my special pleasure to be with all of you, and good morning to all of you. And it was wonderful to see many familiar faces because I have been serving as a keynote speaker for this conference for many years, thanks to Professor Ilwan's kindness. And also, number of times I was introduced as the founding editor of Pacific Basin Finance Journal. And let me just digress a few minutes, just introduce this particular journal to you. And let me share the screen. It says host disabled participant screen sharing. Can I share the PowerPoint file I have? Hello?
Is that the file you want to present?
No, this is just 2-page slide I wanted to show.
Can everyone give Dr. access to present?
Yeah, Leo, can you allow me to share the screen?
Okay, I'm asking for the committee to enable your screen share, Prof. Conry.
Yeah, when I click share screen, it says I'm not allowed to do it. So only a host can share. Maybe I will just click all panelists and then I will do it. Okay.
Yeah, you become co-host now.
Okay, now you can share your screen.
Now let me see what I can show this. You are not seeing, oh boy, I'm asking my email address and all that. Leo, can you allow me just to share the screen?
Yes, actually, you already share your screen.
But how come I cannot do anything to show? Sorry to everybody. We are trying to figure out this technical issue here.
We actually already
What are you seeing?
Yes.
I wanted to magnify this.
Okay. Actually, it's at the
Rather than on the screen, small, nobody can see.
Can you click at the right bottom in your PPT?
Probably you can press F5 on your keyboard, Professor.
F5?
5. Okay. Here we go.
Okay, can you see the big screen or what?
We can see your presentation, but it's in practice mode.
So anyway, what I wanted to show you is we have our top 4 finance journals, and I'm showing you the Thomson Reuters, the journal impact factor scores are shown for top 4 journals. So Review of our Financial Studies, and Journal of Financial Economics, and Journal of Finance, and Journal of Financial and Quantitative Analysis. And then let's go to next page. So once we come to next year journals, we have, can you see the impact factor scores on the right-hand side and all that?
Yes.
Yes or no? Yes.
Yes.
Okay,
Yes.
good.
Yes.
So depending upon which school, which research school you are talking to, they may have a slightly different second-tier journals, but these are the top 4 journals plus the rest of the finance area leading journals. So we are trying to publish our papers. And as you see here at the top, we have Journal of Financial Intermediation, followed by Journal of Corporate Finance. And then we have a bunch of journals. And then you will see the Pacific Basin Finance Journal is up there. And then followed by Journal of Financial Markets, Journal of Empirical Finance, and a bunch of other journals. And I launched this particular journal 30 years ago, in 1993. At that time, the main motivation was there was no specialized journal dedicated to Asia Pacific financial markets. And unfortunately, we have to fight American scholars' myopism, and they think only New York market and London markets are relevant. And then Asian market, including Japan, Hong Kong, Singapore, and all this, they keep asking, why do we have to look into these markets? So that's why I launched this journal, and just to provide the outlets for scholars who are doing research on Asian financial markets. And thanks to many contributions from smart scholars in Asia Pacific region, and also who are active in the US market. So the Pacific Basin Finance Journal becomes one of the leading journals among the second-tier journals. And actually, the second-tier journals do have a very high impact factor scores. So that's what I wanted to share with you. That was it. And then I will come back to my own presentation material Now I have to share again. Just 1 second. Sorry about this. Okay. So I have to do share again. Sorry. I go back to share screen, and now do you see my PowerPoint file?
Yes.
Labor unions?
Yes, you can press the F5 again.
Make it bigger?
Or on the bottom right of your PowerPoint slide.
Okay, now do you see the
Yes, okay.
Okay, good. Okay, what I'm trying to do in this paper, we are trying to see how labor unions affect the corporate decisions, especially we are talking about management forecast on earnings. And I have been working with my co-authors in Japan. So Katsushi Suzuki is a professor at Hitotsubashi University, probably the best business school in Japan. And then Nakako Jushi, she is PhD from Hitotsubashi University, and she is working for Japan Securities Research Institute. And we are using Japanese data and then trying to show there's something we have to learn from Japan, as well as any other Asia Pacific markets. So this is the first study, I would say, which examines the relation between management forecast and unionization. And Japan, like US and other Western European countries, it has a very strong labor union movements. And many companies do have unionized employees, and that will make the significant impact on corporate decisions, whether it's a financing decision or capital structure decisions or cash holding decisions or dividend decisions. It does affect unions, affect the managerial decisions. So that's what we are going to look at. In this particular case, we are looking at the management forecast of net income. And then we also looked at the management forecast for net sales and operating income. The results are very similar, so we don't have to repeat same thing. So I will just focus on my presentation based upon net income. So you may ask why we study Japan. Of course, the Asian markets, very important for research-wise. And especially for Japan, it is important. Number one reason, as you see here, for US studies, US union-related studies, we do not have company-level union data. So what they do, US scholars do, is they use the industry-level union data and then come up with the major conclusions and findings, and they believe that this will be applicable to all the companies in the same industry. But that is not true. Fortunately, in Japan, we do have individual firm-level union data. So we can look at the specifically how labor unions can affect the individual firm decisions. That's not possible in the US market. All they do is just approximation for the firm level based upon industry level analysis. And then second, management forecasts. In Japan, management forecasts are mandated. All the listed companies have to come up with the management forecast, but in the United States, it's a voluntary basis. So that means only those companies who feel confident about themselves will come up with the their forecast. And in a sense, we do have a serious self-selection bias if we just use the US data with the management forecast. And number three, as you see here, in Japan, almost 100% of our listed companies, they are using point estimates for the forecast information. In contrast, in the United States, almost 80% of the companies are using range forecast. So once we have a range forecast, we will have an upper level value or lower level values, and then which one we trust. So we just come up with a range of a lower to top level numbers. So usually what happens is managers, they expect that the upper level values would be relevant. So that's what many of our US studies found. And also when they look at the financial analyst perception of this range forecast, of course, the financial analysts, they will look at the bottom numbers rather than top numbers. So that kind of problem we don't have in Japan, because they do have a point estimates. Almost all the companies doing that. So that's why Japanese data are very unique. And so that's why I insist to our US scholars, colleagues, look, when we look at the Japan, we can come up with the much better studies than what we observe in the US market. And then when we look at the collective bargaining, in the US market, about every 3-4 years, they do have this bargaining session with the unions and between the union and management. But in Japan, it's an annual event. So that means much more active communication and interaction between unions and company management exists. So that will help this kind of analysis easily. So in this paper, we have two specific hypotheses. The first one we call the rent extraction hypothesis, and then second one we call the unemployment cost hypothesis. As you see here, firms with labor unions tend to understate management forecasts. In contrast, on the second hypothesis, they tend to overstate. So I will explain why this happens. So rent extraction hypothesis. Usually what happens, they're afraid of labor unions pressure. So what they do is they take strategic actions to minimize any exposure to rent extraction from labor unions. So what they do, for example, they reduce excess cash flows or increase financial leverage, or they reduce cash holdings so that unions wouldn't come after hey, you have a large amount of cash holdings, let's share. So they avoid that kind of problem, and also they increase dividend payments, or they withhold the good news and promote bad news, or deflate the tone of our earnings press releases, or increase operating leverage. And they pay CEOs less on the surface, and then lowers the corporate social responsibilities. So that's what they are trying to management are trying to do under the rent extraction hypothesis, because they are afraid of labor unions pressure, and then rental extraction and all that. And then second hypothesis, unemployment cost hypothesis, exactly opposite. So managers, they are trying to convince unions, hey, you are in good shape. We are doing good job. And companies far from financial distress or bankruptcy risk. So usually what they do, they decrease their financial leverage. And they increase cash holdings and decrease capital expenditure, and then smooth earnings and engage income increasing real earnings management and all this. So exactly opposite thing happens. So at the company level, we have to examine really what's happening, how unionization affects the financial decisions or investment decisions or all kinds of other decisions that managers are making. So that's what we are looking at in this paper. And one more thing I wanted to mention here is I cited a bunch of papers, very important papers in major journals. They look at the US state level adoption of the right to work law or the wrongful discharge law or state unemployment insurance law. And then what happens when the certain states adopt this kind of laws, and then what will happen to the companies in that particular jurisdiction of the state. So they demonstrate the decline in debt ratios or investment expenditures, increase in cash holdings. And so it creates lots of interesting situations we would like to analyze in relation to the labor union movements. So in this paper, let me give you major findings first. Number one, we support rent extraction hypothesis. So that means unionization does negatively affect the management forecast of net income. And then another important thing is, remember in the US market, we don't have our individual firm level union data. So we try to do analysis using industry level data and then try to come up with some kind of approximation for firm level. But that can mislead give misleading information. So management forecast bias differs between unionized firm companies and non-unionized companies, even within the same industry. So even within the same industry, the companies are different. They behave differently. Managers behave differently. So this is the kind of thing we find using Japanese data. And then number three, timing of our information flow. Managers, they tend to understate management forecasts more and substantially in anticipation of our upcoming collective bargaining schedule. So that's what they are doing. And then when we look at the governance mechanism, for example, foreign ownership or managerial ownership, do they help? No, actually, they are just going with the overall trend. So they try to understate whatever the earnings numbers, given in the presence of labor unions pressure. So as you see here data, we have a study period from 2006 through 2017. So we do have all the financial statement data and stock price data. And then the most important thing is the Thomson Reuters IBIS data, so institutional brokers estimate system, so we can gather the consensus analyst forecast data. And so this is the kind of data we have. And then sample selection. As you see here, total number of our management forecasts on net income, we have almost 200,000 of them. And then we just filter through the unusual things, and then it comes down to about 150,000 management forecasts. So about 75% of our data we are able to use, and this management forecasts are coming from about 4,000 listed companies. So that's what we have. So the model is very simple. What we are doing is we look at the forecast bias, which is dependent variable, which is affected by the union and the number of our control variables, and then year fixed effect and firm fixed effect. And as you see here, forecast bias in net income, or we can choose the operating income or net sales and all that. And then we take a look, and that will be simply management forecast, the difference between management forecast and then actual value. And then you may think they become negative number. No, actually that's not necessarily negative. Of course, when we compare unionized companies and non-unionized companies, we see the dramatic differences between the two groups. And so the difference, the forecast bias could be negative, or it could be just positive. Anything could happen. And then we have our individual firm union data. And then I wouldn't go through all this control variable and all this. So we go to next. So we have our summary statistics here. So you see the forecast bias. It's not negative numbers, so it's a 0.009. And then as you see here, about 34% of our Japanese listed companies do have our labor unions. So about 60% non-unionized, and then about 35% unionized. And then we have maybe we can go to the next statistic. So here I wanted to contrast between unionized companies and the non-unionized companies. See how big the forecast bias is. So when we look at the difference between unionized companies and non-unionized companies, mean difference is negative 0.008, which is very significant. So that means under the pressure from the union, the management is trying to just come up with the smaller number possible for management forecast. That's what they are doing on net income. And as I mentioned, on operating income, same thing happens. And net sales, same thing happens. So this is what we are observing. And then, as you see here, when we look at the management forecast bias by industry, you see here almost all of them are the difference between unionized and non-unionized companies. They are all negative difference, except one. I think this is non-ferrous metals or something. So that's not even significant. So that's what we are seeing. So whichever industry company belongs to, when we compare the unionized and non-unionized companies, this is what we see. Union put lots of pressure to underreport or underestimate the earnings forecast. So correlation matrix, the most important thing is this number one variable will be the forecast bias. And then you see the union, they have a negative correlation, which is kind of an early indication of union's pressure to underreport the earnings numbers. And then when we look at the other correlation data, companies' previous losses or standard deviation and all this do have a positive impact on the forecast bias. And then we move to next one. So this is the kind of main regression results. So initially, when we do the just union regressed on forecast bias, we see the negative coefficient is significant. And of course, we capture the firm fixed effect and industry fixed effect and all year fixed effect and firm fixed effect. But the problem is once we go to the next column, we introduce all the control variables. We don't see the negative coefficient anymore. So this is trouble, but in empirical studies, this is what we have to expect because of typical problems related to endogeneity and then missing variable issues and causality issues. So all these things will create the interesting issues for empirical work. So in this case, the easy way out is we use the IV variable. So we go through two-stage regression analysis, and then we know the as you see here, the tenure system. So how many years the employees have been working for the company. So we see the, okay, so this could capture the significant amount of potential, the endogeneity issues or missing variable issues and all this. And then we have a first stage regression, and then we go to the second stage regression, and then the regression coefficient we estimate for the union has a significant negative impact. So this is what we are looking for. And actually, I have been talking to my co-authors, hey, let's reinforce our instrumental variable approach to make it more convincing. So I even suggested to them that why don't we take a look at the, for example, Korea's union data. So same industry in Korea, and we use that as a some kind of a proxy variable or instrumental variable for Japan. And then in Japan, the Korean data wouldn't have anything to do with the forecast bias and all this. And so there are many interesting approaches we can do. So at this moment, we are just reinforcing these overall findings on the negative relation between union and forecast bias. So once we establish this negative fact relation, and then natural question we have to ask is, what happens when we think about firm characteristics? So what about the when companies are profitable or company faces serious industry level competition? So I'm referring to Hoffinder index and all that. And then the vulnerability of economic recession and sensitivity or economic policy uncertainty or foreign ownership or the executive ownership, and then timing of collective bargaining on this. So we have to think about all kinds of possibilities. What will happen to this major negative relation between unionization and forecast bias? So that's what we are doing here. So firm profitability. We identify those companies with the very strong positive profitability showing up, and then we see what happens. And very strong negative relation between union and profitability. So we see the coefficient estimated for interaction term of a union and high return on assets. So that's what we are looking at. What about competition? If company faces strong competition within the industry, and then what will happen? Probably in that case, maybe the unemployment cost hypothesis could be working. So that means the relationship could be positive rather than negative. No, but once we identify those the industry with the strong competition and all that, and we are seeing the still negative impact. So that's what we are seeing. And what about the economic recession? And in the US market, we look at the NBER, National Bureau of Economic Research, to identify recession period or normal period, economy and all this. But in Japan, Cabinet Office, one of the ministries in the government, releases this information. So we follow the cabinet office's information to find out the recession period. And then what happens during recession period? Probably the second hypothesis, which I mentioned, the unemployment cost hypothesis could be more supportive. So that means the relation between union and recession could be positive. But no, when we introduce capture the recession, this is what happens. So even during recession period, we see the managers, they are trying to avoid this kind of pressures. And then let's go to the next one, economic policy uncertainty. And I know many of you are familiar with for example, Baker, Bloom, and David's the QJE article in 2016. For Japan, we have a bunch of scholars who have been following, creating this economic policy uncertainty index for Japan, so composite index, and then they also have a foreign policy, fiscal policy uncertainty, or the monetary policy uncertainty, or exchange rate uncertainty policy, or trade policy. So going back to 1987, and they have complete the index numbers in relation to economic policy uncertainty. So when we look at those companies facing the serious economic policy uncertainty, again, we may think maybe these companies went to extraction hypothesis may not work, but that's not the case. So what we are seeing is, again, negative significant coefficient we observe. And then what about the foreign ownership? So we identify what's the percentage of foreign ownership, and then we look at the foreign ownership impact. And then what we see, again, the interaction between union and foreign ownership, significant and negative. So that means you may think the foreign owners, maybe they are familiar with the good governance system practices and all that, so they wouldn't do this kind of thing. But I guess after all, money is important. So we see this kind of negative impact. And then what about the executive ownership? So the company managers or president or directors, they do have internal ownership of the company. And then what they will do? Maybe what we are seeing is, again, negative relation. So no matter what, when union is out there, and then they try to manipulate. So that's what we are seeing here. And then timing of our collective bargaining. So in Japan, usually collective bargaining is conducted in the last quarter of the year. So between September and December, that there will be a collective bargaining. And then we want to see first 3 quarters. So first quarter, second quarter, and third quarter, what happens? So when we take a look at the interaction term between union and pre-bargaining quarters, and again, we see the significant negative coefficient. That means, as we predict, the Japanese companies, they try to stay away from union's pressure. So that's why rent extraction hypothesis is consistently supported. So that's what we are observing. And then the last thing we wanted to do is earnings management. So I know many of you are familiar with the accounting area research and earnings management. We have discretionary earnings management and real earnings management. So we come up with the measures for discretionary earnings management measures, and whether they are positive or negative, and we have all these different scenarios, and then real earnings management, and again we bring in all kind of possibilities, either positive or negative and all that, and see whether the earnings management practice itself can show there are some differences. But as you see here, everything negative and significant. And whether we are looking at discretionary accrual management or real earnings management, it doesn't matter. So consistently we see negative, and whatever we are looking at is just management is trying to avoid the pressure from labor unions. So in summary, what we are seeing is unions downward pressure on management forecasts. We are just looking at one small segment of managerial decisions, but when you look at other decision-making processes, same thing will happen. So what we are seeing here is rent extraction hypothesis is fully supported. So I have one last slide for you, especially for Indonesian researchers. So when I look up the Indonesian labor union situation, I see it goes back to 1992 during the Suharto period. And then we have a bunch of union organizations. I'm sure I don't know how strong they are, how systematic, how much organized, all that. But I see Indonesia do have these unions and then union movements and all that. And then I see occasionally some union-related enactment comes in, and then it becomes a big issue and all that. And that will create the wonderful research opportunities for us. So what we want to do is, what's the current status of these unions? And then we identify unionized and non-unionized listed companies, and then we look at their investment, financing, financial leverage, or operating leverage decisions. All these things will be a wonderful, wonderful research opportunities. So I think that's my presentation I planned today. I hope you see my point overall. So Japan is, in a sense, it's an advanced market. And then you may think the Japanese market or managers, they treat the union kind of in a peaceful manner and all that. But no, they are always trying to avoid the union's pressure. And then whatever decision they are making is for the best interest of the company or owners, shareholders. So that's what we are seeing.
Okay.
So that's my presentation.
Okay, thank you, Professor Ri, for your interesting presentation. So we have probably around 10 minutes for the QA session. So any question? If you have question, you can write in the QA box, or you can talk to us directly.
Thank you, Mamdu. By the way, I sent my PowerPoint file and also my paper to Leo at Gajah Mada University. So you can ask him, hey, let's share the paper. And once you read, you will see there are lots of interesting issues you can address. But if you can identify Indonesian local situation vis-a-vis labor unions, how strong they are, and what kind of issues companies are facing, and there are lots of research opportunities we can do.
Okay, yeah. Okay, we'll try to do that, Professor Ri. And then I think I saw someone raise his hand. Yeah, Pak Loren. from
Thank you, Pak. Thank you, Pak Mamdu. I have several important points to talk here. First of all, Professor Gondry, how are you, Professor?
Thank you, thank you. I'm doing very well. Yeah.
Yeah, we met a few years ago back in Brisbane.
We did.
Do you still remember? Yeah.
Ali.
Yeah. And yeah, I have one published paper in Pacific Basin Finance Journal.
Okay.
And, yeah, and I also have another one that I'll be presenting today. Currently at the revise and resubmit stage.
Oh, you are the one who told me we met in Griffith University?
Yeah, Griffith. Yeah, that's
okay. Yeah. Now I see your face, I remember.
Okay, first of all, thank you, Professor, for a very insightful presentation. This is a working paper, isn't it?
It is.
Okay, yeah. So it's still a working paper. Yeah, so from my understanding, your paper look at the impact on labor unions on management forecast bias, right? Is there any test that where you look at the impact of labor unions on management forecast era? I think it is also interesting to see, right?
Oh, definitely. Yeah. Yes. This is just beginning. Yeah.
Okay.
We can do lots of studies actually.
Yeah, I think that's
as I mentioned, dividend decisions, or cash holding decisions, or real investment decisions. All these things could be a wonderful topic, especially for corporate finance majors.
Yes. I also saw that you test on EPU. I think there's another index also. There's a very interesting to look at the GPR index, geopolitical risk. I think that's also another opportunity to test. And regarding
as I mentioned, for Japan, the economic policy uncertainty for different segments of the economies and also the composite economy, we have all this data available. So you can do quite a bit of interesting studies focusing on Japan. So if you do the labor union studies throughout your lifetime, you can do nothing but labor union studies.
Yeah.
So many things to do.
So many things.
Yeah.
And regarding your results, you found that labor unions negatively associated with forecast bias. So I think
definitely yes.
Yeah. So that means labor unions makes managers to be more conservative, right, in their forecast. I think that's one explanation. And I also saw some papers that very similar to your current work right now.
Okay.
For example, by OFA 2012, he looks at the impact on labor unions on management incentive to signal a negative look, and I think the results are very similar to yours as well. And another alternative explanation is that manager may have incentive to strategically signal a negative outlook to their unionized workers in order to improve the firm's bargaining position. That's one paper. Another paper is, I think you cited this already, from Chang et al.
Okay.
Yeah.
I think that's the paper in management science.
Yes, management science. Yeah.
Yes.
Yes. So another alternative explanation, yeah, I think very similar, to achieve better outcomes in labor negotiations. Yes.
Since you are very familiar with this area of research.
Not really. Yeah, just Google. Just Google the papers. All right, now yes. Yeah, so I think that's all from me, Professor Gondry. Nice seeing you here. Thank you.
Yeah, thank you. Okay, any other question? Okay, while waiting for the question, I have a question. Your finding seems troublesome because you are indicating that there is agency conflict between employees and stockholders. Am I correct? not in Japan, because
I guess so. Yeah.
We see Japan as a country that consider employee as an asset rather than cost factor. But even in Japan, there is some serious agency problem. Is that correct? Yes.
True. Yeah. But my question to you, Mamdu, how strong labor unions are in Indonesia?
Unfortunately, I'm not familiar with this issue, Professor. So probably I'll have to ask someone else here. Anyone?
Do you have any good idea about unions' strength in Indonesia in general?
Me? I'm not really familiar with the activities of labor union in Indonesia. But we can find out. We have some colleagues who are very into this kind of research.
But it looks like very recently in Indonesia there was a major debate in relation to a union-related enactment the government introduced, and I think that kind of enactment will be a good momentum to study before and after how it was decided for the future direction and all this, and how there are wonderful opportunities to study here.
Yeah. And then one thing, Professor, you introduce the ownership, executive ownership, okay. But then how about introducing employee stock ownership plan, which is probably more directed toward the employee, right? And then in this case, the ESOP, this is probably usually considered as a method to align the interests of stockholder and employee. So if you introduce that variable, probably.
Yeah, it's a very insightful point. We do look at the managerial ownership, how it affects. But if we collect the data on employee ownership, that would be a wonderful paper. And then we can pick up the whatever topic related to labor union, and I think that would be a wonderful new study we can embark on. Thank you for your idea.
Okay, any other question? Okay, let me ask one question because while we're waiting. For the journal, the backup journal you mentioned, in Indonesia, we usually look at the rank by the SIMACO GR ranking, right? And then they classify into 4 quartile, Q1, Q2, Q3, and Q4. Okay. Then for the backup, recently I saw backup classified as Q1. Okay, that's good. And then sometimes in previous period, they classify, they include the backup journal as Q2 journal, which doesn't seem look good, right? Can you explain why the score you show is high, but then sometimes the SIMACO include that in Q2 rather than Q1.
I'm afraid, Mamdu, you are losing me. I didn't follow your question clearly.
Okay, we usually in Indonesia we use SIMACO GR ranking journal. Okay, and then they have 4 quartile: Q1, Q2, Q3, and Q4. Okay.
Yeah.
And then we look at we look for the Q1. Okay. For the backup journal, recently they add backup journal into Q1. Okay. But then in the previous period, like last year, for example, or last 2 years, they include backup into Q2 journal, not Q1. But you show that backup journal actually has a high score, right? So my question, how come?
Yeah, I'm afraid I'm not familiar with all the specific details you are referring to.
Prof. Gondry, allow me to clarify. So in Indonesia, in Indonesia, we usually use the Skimago journal rankings. And Pacific Basin Finance Journal, I think in the last 2 years, right, Pak Mamdu, was classified as a Q2 journal. Yeah, so Q1 is the highest, the portal, and then but now I believe it's Pacific Basin Finance Journal is back on in Q1, right? Yeah, so the question is why in the last 2 years the journal rankings dropped to the Q2 classification. So I think that was the question.
I wish I know everything. But one thing I can tell you is Pacific Basin Finance Journal will be one of the leading journals in the finance area. So after we just count top 4, and then we have to think about European Finance Association's annual publication, Review of Finance, and then Asian Finance Association's official journal, which is Pacific Basin Finance Journal. And we will have this kind of regionalized market-based studies, which will be right after the top 4 journals. So I'm very optimistic that Pacific Basin Finance Journal, like the Review of Finance, it will be right after the top 4, and then next 3-4 journals will be in one of them. That's how my expectation goes.
Okay.
So I hope we have more papers coming from Indonesian scholars. We have many submissions from scholars in the US and China and Australia and Hong Kong and Taiwan and Singapore, but we don't have that many submissions from Indonesia. So we need more submissions. So that's why I love to come to Indonesia for official excuse, and then visit many universities and talk about, hey, this is important. So let's do more research on Indonesia or even Malaysia. So that way the Indonesian market or Malaysian markets will be one of the major the blocks of markets we have to really focus on.
Okay.
At this moment, among Asian markets, we focus on China, Japan, Australia, Singapore, Hong Kong, but not much activities. So we need expand our scope of research in Asia.
Yeah, thank you.
Indonesia is a wonderful place.
Yeah, we need your help and your guidance to to submit more papers.
Yeah, please invite me to give talk. I will be happy to come and give seminars.
Yeah. Okay, I guess we already end our session. Thank you, Professor Corey, for your presentation. Thank you, Lauren.
Picture taking.
Yeah, I'll hand it back to Tanti, and then probably Tanti is going to arrange some photo session for you. I'm not sure.
Yeah,
Yes.
Ibu, Yolanda, we don't have any picture taking session.
Yes, of course. We're going to have a photo session first before ending the first plenary session. Please stand by in front of your camera and give your best smile. The committee will take the picture.
Okay.
Okay, please wait a moment. Is Prof. Ted available? Prof. Ted? Okay, I don't think he's standby in front of the laptop. Probably we can do the photo session. Okay. 3, 2, 1. Once more. 3, 2, 1. Okay. Thank you, Professor Gonri, and also
Thank
Prof.
you,
Mamdu.
Yolanda. Yeah, thank you.
Thank you. Bye-bye. Thank you.
Bye, bye.
For the second plenary session will be delivered by Associate Professor in Southampton Business School, University of Southampton, Dr. Renata Kizis, BA, MA, MSc, PhD, FHEA, which will be moderated by Chair of Study Program of Management, Faculty of Economics and Business Universitas Gajah Mada, Mr. Iwayan Nuka Lantara, MSI, PhD.
Thank you so much.
Thank you.
First of all, I would like to thank the organizers for this opportunity to present at this conference, and also it has been a great pleasure to present the same session with Professor Gonri. Of course, my topic, as probably you have seen, is very different. Let me share the screen. Can you hear me, by the way?
Very clear. But
Very clear, Professor.
Excellent.
Very good,
Excellent.
very good.
Excellent. Okay, so that would be my presentation. So I am from the University of Southampton. Yeah, so the topic on which I'm going to present you is entitled Temperature and Sovereign Bond Markets. So this research has been written in collaboration with my co-authors, Ruth Tabi from Montpellier Business School, France, Sakum Umar from Zayed University of United Arab Emirates, and Adam Zaremba, also from Montpellier Business School, France. So it's truly international. Right. So, of course, you ask me, why particularly this topic? Why is it interesting? And of course, there has been a lot of debate in the literature and also in the media as to the potential economic effects of climate change and global warming. Has been some studies on the effects of financial markets, on stock markets, but there is no study that has investigated the temperature effects on sovereign bond markets. So let me take you first through the presentation structure. So first I will introduce you to the topic, then I will briefly review the literature. I will set out the hypothesis to this study. Then I will describe the data. The data description will be followed by the methodology. And then I will analyze results. I will also present some robustness checks, and I will summarize the key research findings. Okay, so why is this topic, first of all, interesting? So it has been essentially inspired by a Financial Times article which was published in the previous year on the physical and transition risks of climate change on sovereign bond markets. Since climate change is likely to negatively impact on the infrastructure and physical assets. So therefore, it will have adverse effects on the economy, which will be also spilled over onto financial markets. So now the literature indicates that the temperature has adverse effects on the economy and financial markets. So first of all, it affects the agricultural sector, and this can be very relevant for Indonesia. It can also influence labor productivity, so people become less productive when there is the climate change in hot temperature, as we already all know. Of course, it can also obviously affect economic growth and production, as well as income level, professional decision-making, because the professionals are also influenced by waves, for instance, of hot weather. And interestingly, in the paper, Donadeli and others, and that includes myself, we also studied the effects of temperature shifts on research and development expenditure growth. And so this paper is partly empirical and partly theoretical. So in the empirical part, we identify negative effects of temperature shifts on R&D expenditure growth in the OECD countries. And then in the theoretical part, we also studied theoretical channels of this effect. And so we identify three potential channels. So one is the capital quality channel. The second one is the so-called patent obsolescence channel. And the third is the labor productivity channel. And also there is literature that shows that there are physical and transitional risks that might affect companies in different ways. And as companies are affected, so therefore the investors can choose to invest in more secure, less risky assets. So physical risks involve risks that the assets can be negatively influenced by global warming. And transitional risks are risks that companies face when they actually move from brown towards more green activities. So the overarching research question that we ask in this article is whether investors in sovereign bonds markets price information about global warming and temperature rises. And in this paper, we distinguish among three potential views, if you like, or channels. The first is the so-called behavioral psychological channel. According to this channel, it's very interesting that high temperature can cause aggression and apathy for different groups of individuals, and that was shown in early research by Wingham in 1969. Also, further research, which was undertaken by Conway in 2005, shows that low temperature facilitates more aggressive risk-taking. So people, and therefore investors, become less risk-averse, more risk-taking, and so therefore they would be willing to invest in more risky securities. But also the same authors, Gao and Wei, so they show that high temperature apathy dominates aggression and therefore impedes risk-taking. Okay. So if investors typically choose between risky securities such as stocks and safe securities such as sovereign bonds, so that will influence their decision to either invest in risky securities or safe securities. If temperature is high, so they can become more apathic, so more risk averse, and therefore they would prefer to invest in safer securities such as sovereign bonds. Now, if temperature is low, so that makes investors typically more aggressive. As they become more aggressive, so they will tend to invest more in therefore risky securities and less in safer securities such as sovereign bonds. And that leads us to the first hypothesis. Yeah, according to hypothesis 1, returns on sovereign bonds increase in response to positive temperature shifts. Yeah, so if, for instance, initially investors have invested in stocks, so they can liquidate their stock holdings and instead invest in bonds when temperatures are high, and vice versa happens when temperatures are low. Okay, so that is the first channel. Now, according to the second channel, so we hypothesize that macroeconomic channels, which were also mentioned in the introduction, also influence positively sovereign bond returns, but only after a certain threshold, right? So specifically, we hypothesize that the response of returns on sovereign bonds to positive temperature shifts is U-shaped. Okay, and this is very much in line with research that indicates that expected losses caused by natural disasters increase quadratically with temperature rises, and that was shown by Bansal and others in 2016. Yeah, and as I mentioned, so this is also my research, Donnelly and Tata, 2021. So we identified 3 theoretical channels. So according to the first theoretical channel, high temperature erodes the value of patents. Yeah, and of course, it erodes the value of future production produced using those patents. It also depletes capital stock. The existing capital stocks becomes more obsolete at an increasing rate. And also high temperature dampens labor productivity, so people become less productive. So this is the macroeconomic channel. And the third channel is the so-called energy-based channel, which is kind of relatively new. So it affects the economy and financial markets through the increased demand for energy. Yeah, and so that was also studied by Wigley in 2019, and Tsuwanas and others, including myself, in 2019 as well, and Killian in 2009. So, for instance, Wigley in 2019 and Tsuwana in 2019 show that high temperature leads to high demand for energy used for cooling, yeah, when temperature is hot. Now, when temperature is low. So you need to spend more in energy for heating, right? That's correct. Now, for the companies, that means that they would probably need to go to Chicago Mercantile Exchange and purchase weather derivatives, right? In order to hedge against, let's say, deviations from normal temperature, either upwards or downwards, right? As they need to spend more on those weather derivatives, so they need to borrow, yes, and as they borrow, they become more leveraged and therefore risky. Yes, so that leads to negative impact on their future profitability, right, and therefore stock markets. Now, on this basis, investors may choose to liquidate the stocks of these companies and instead invest in sovereign bond markets in order to avoid this risk. Now, there is also a third view, or shall I say sub-view, which was put forward by Kidia in 2019, albeit more indirectly. So what he shows is that there are three oil shocks, so he distinguished among three oil shocks. So the first is the oil supply shock. The second one is the aggregate demand cost oil shock. And the third one is the so-called precautionary demand shock, which means that the companies, when they anticipate, let's say, in the future, shortage of energy, so they will decide to invest more in inventories, more in storage. And of course, there are certain types of energy, such as electricity, which essentially cannot be stored, right? But the point here is that if you invest more in energy, so again, your costs will rise and you become more leveraged, and therefore that can damage your profitability prospects. And so again, investors have an incentive to liquidate your stock holdings and invest instead in sovereign bond markets. Okay, so we try to test for those hypotheses. We're not able, to be totally honest, to totally distinguish among these three channels, but just to anticipate our results, we can discard one of the channels, and that is the energy demand-based channel. And I'll explain you why. So we use data on daily total returns on data stream government bond indices in this study. And we consider 2-year, 5-year, 10-year, 20-year, and 30-year sovereign bonds of 31 developed and emerging market countries from Africa, Asia, Europe, North America, and Oceania. And of course, Indonesia is there as well. The sample spans from the 1st of January 1980 to 18th of September 2020. So as you can see, we have 40 years of daily data, so it's quite substantial. Now, we match those countries' bond indices with the closest weather station, which is captured by the Global Historical Climatology Network daily database. And so this database is a product of the National Oceanic and Atmospheric Administration and contains state records from more than 100,000 stations worldwide. So we match with the closest one. So combining the number of countries in our sample, so we have 31 countries in the time period. So the final sample consists of final data of 225,390, shall I say, bond day or country day observations. And of course, the sample size varies across different model specifications because of the availability, or shall I say, unavailability of various control variables. So what are we controlling for here? We first control for the macroeconomy, because in sovereign bond pricing, macroeconomy matters, right? Because sovereign bond prices, the risk depend on also the country's fiscal position. So what we use here is the annual GDP growth rate, inflation, and unemployment. So GDP growth rate approximates business cycle fluctuations, whereas inflation captures macroeconomic instabilities. Now, the unemployment case is interesting because Boyd and others in 2005 show that unemployment-related news carries information contents about future interest rates, equity risk premium, and corporate earnings. So in our empirical models, which we use to test our hypothesis, the macroeconomic variables are lagged by 3 months in order to avoid the so-called look-ahead bias. Now, in addition to macroeconomic variables specific to those 31 countries, we also use bond-specific characteristics, which are the so-called convexity, duration, market value, and also sovereign ratings. So these variables are extracted from data stream. So I'm pretty sure that most of you who work in the area of finance are familiar with these variables. So duration measures the average lifetime of bonds stream of payments. So the longer is the duration, the more sensitive is the bond price to interest rate changes. So in a way, kind of a measure of interest rate risk. And the convexity is a measure of the curvature in the relationship between the bond price and the interest rate. So as you know, there is a negative relationship typically between the bond price and the interest rates, but the convexity quantifies the curvature. So it indicates how much the bond's duration changes when interest rates move. And again, this can be regarded as a measure of interest rate risk. Market value is simply the government bonds portfolio's total market value. Now, we will also include a sovereign rating. So as you know, sovereigns and also banks are rated by 3 major rating agencies: Moody's, Standard & Poor's, and Fitch. So from the letter symbols, we actually code up numerical values, which range from 1 to 21. So the variable assigns the value 1 to, for instance, AAA ratings, the value 21 to C ratings, and we follow in this sense Abramov and others in 2012. And then subsequently, since we have 3 rating agencies, so we take the average of those 3 ratings, and so we calculate the cross-sectional mean of numerical ratings by those 3 agencies. In terms of the countries that we include in our sample, so as I mentioned, we have 31 countries. And so our sample comprises developed and emerging market countries. Yeah, and so I'm not sure if you can see very clearly. So we have like a time series of cumulative return on 10-year sovereign bonds for those 31 countries. So if you invest in the beginning of the sample and will sell your investment at the end of the sample, so that's what actually this graph displays in some countries actually sovereign bonds prove to be quite profitable investment vehicle for some other countries. So government bond portfolio hasn't been as profitable. So now in terms of the methodologies, we use empirical research methods, and in particular we use panel data models to test debt-free hypotheses. So how do we test the first hypothesis? And remember, the first hypothesis implies that there is a positive but linear relation between sovereign bond prices and temperature shifts. Okay, so in this model, sovereign return in country I on day T is on the left-hand side, it's the dependent variable, yeah, and temperature, the actual daily temperature, and we follow therefore research of Cow and Wade, 2005, as I mentioned previously, and also Kamstra and others of 2003, published in the American Economic Review, who also used daily temperature levels. In terms of control variables, so as I mentioned, we control for macroeconomic variables and for bond-specific characteristics. So these variables are captured in the vector X. In addition, we also use year dummies, time trend, and weekday dummies to capture different types of anomalies. But also, year dummies typically capture any structural changes in sovereign bond yields, right? And the time trend, which we use, also captures similar structural characteristics and also any effect of general global warming. So we control we want to control global warming in order to identify the exact effects of the nearest weather station on bond market behavior, right? And as I mentioned, according to the first hypothesis, B1 is positive, so the temperature has a positive effect on sovereign bond returns. Now, in our mainline models, we used fixed effects estimation methods. And the fixed effects means that we want to control for any unobserved heterogeneity among those 31 countries, such as, for instance, the perceived riskiness of bonds among the investors, because even though sovereign bonds are regarded as risk-free vehicles of investment, but perceived risk sometimes is different from their, this notional risk-free investment. Now, the second hypothesis implies that now this relation between sovereign bond returns and temperature shifts is no longer linear, is now quadratic. So we also now include temperature squared in our regression models. So the second hypothesis implies that there is a U-shaped relationship, which means that beta 1 is negative, beta 2 is positive, although, to be honest, there is no very strict view as to what beta 1 should be, whether it's positive or negative, yeah? But if it's negative, so there will be some threshold temperature, after which the relationship between sovereign bond returns and the temperature variable will turn from negative to positive. And now, moving to hypothesis 3, we now test the energy-based channel, and that is the so-called DDIT. So we have two variables, So one is the so-called heating degree day, and the second one is the cooling degree day. So these variables are also used as a basis for pricing of weather derivatives, and so we follow the same methodology. So what is the CDD, the cooling degree days? So that is the maximum between the actual temperature and 65 degrees Fahrenheit. So temperature is measured in Fahrenheit, right? So if temperature is too high, so this means that there is hot temperature shocks which requires cooling, and that's why we have this cooling degree dates. So there's sometimes confusion whether actually cooling degree days means hot temperature shocks, but that's how it is. And then for heating degree days, we have the maximum between difference of 65 and the actual temperature and 0. Yeah, which means that if temperature falls far below a certain threshold, which is 65, so then you need to switch on your heating, right? And so this essentially implies a cold temperature shock. But the energy demand-based view also signifies that both hot and cold temperature shocks lead to an increase in sovereign bond returns. So therefore, we expect that gamma 1 is positive. And again, we use fixed effects. Okay, now moving to our results. So I should also mention that we use 3 temperature variables. We use the daily maximum, we use daily minimum, and we use the daily average. Yeah. Now, I'm not sure if you see very clearly the table of the results. The main results are highlighted in red. Yeah. We have, for each temperature variable, we have 2 columns, yeah, and the only difference between these 2 columns is that on the left-hand side column, we have year dummies, no trend. On the right-hand side column, we have a linear trend in the model and no year dummies. And in all specifications, we also have weekday dummy variables to capture potential anomalies in sovereign bond markets. Okay, so as you can see, there is a positive and significant relationship between sovereign bond returns and temperature shifts. So in a way that we can uphold hypothesis 1, according to which returns on sovereign bonds increase in response to positive temperature shifts. So this particular model specification does not foresee nonlinearities here. And so in our next step, we do consider nonlinearities, and we particularly ask whether there is a U-shaped relationship between sovereign bond returns and temperature shifts. And so we're testing here whether our macroeconomic paradigm is valid. Okay. So moving to our hypothesis 2, to our quadratic model, right? So again, our key results are in red. So as you can see, the beta 2 here is always positive and significant. Well, only for the minimum temperature is significant at 10% significance level. Yeah, now beta 1, significance of beta 1 varies according to temperature variables. It is negative and significant for the average temperature. It's insignificant for the maximum and minimum. Yeah, so in a sense, we can broadly agree with the hypothesis 2, according to which there is a U-shaped relationship between these 2 variables. Yeah. It also allows us to determine the temperature threshold above which this relationship becomes positive. So given the various specifications that we are testing. So the estimated threshold ranges between 25 and 50 degrees Fahrenheit. And then when we consider hot and cold temperature shocks, so we have different model specifications for hot and then also for cold temperature shocks. So if you require cooling, let's say in your company or your household, so this means that there is a hot temperature shock. So therefore there is a, as you can see, there is a broadly positive relationship between sovereign bond returns and hot temperature shocks. That's what we were hypothesizing. Now, in this estimation table, I do not display the effects of control variables and other effects, because we focus just this main relationship. Now, in terms of the cold temperature shocks, so remember that if there's a cold temperature shock, so therefore we need to switch on the heating care. And again, according to the hypothesis 3, we would expect a positive relationship. And however, this relationship here turns out to be negative, which is like more in line with hypothesis 1 than hypothesis 3, to be honest, right? So essentially across those 3 channels, we have provided evidence favor of hypothesis 1 and hypothesis 2. Now, it is kind of tricky to distinguish using just empirical methods between those 2 channels. So ideally, we should take into consideration also theoretical models to distinguish between these 2 channels or use additional evidence. Okay, but in addition to this, we run several robustness checks. So one of the robustness checks involves the so-called seasonal affective disorder, right? Because when there is a low temperature, so remember that it can cause aggression and therefore risk-taking in financial markets. That can may not be the only behavioral outcome induced by low temperature, because, for instance, in the fall and winter periods, low temperature shares information contents with the so-called seasonal affective disorder, which has been actually studied first by Kamstra, Kramer, and Levy in 2003 in their publication American Economic Review. So seasonal affective disorder is a clinical condition that can affect investors during the seasons of fewer daylight hours. That happens during fall and winter months when temperatures are lower. So individuals and therefore investors are typically deprived of daylight during autumn and winter, and that can result in depression and therefore low risk taking. So we also control for this in our regressions, particularly in the linear model and in the quadratic model. So how do we calculate this seasonal affective disorder? So in this sense, we follow also Kamstra and others in 2003. So the seasonal affective disorder is calculating as the number of hours of night in either the northern hemisphere or the southern hemisphere minus 12, which is the average, so to say, number of hours of daylight, right? So lambda t here is the sun's declination angle at latitude delta. And like I mentioned, we totally follow in footsteps of Campster and others. Julian here is a variable that takes values from 1 to 365 or 366 in a leap year, and it represents number of days in the year. Okay, so we include this additional variable, and we ask ourselves whether the results are not modified by this inclusion. Similarly, we do for hypothesis 2, we ask whether our findings in terms of hypothesis 2 are also valid. Okay. So in terms of the linear model, so what we find is that when we include the seasonal affective disorder alongside our temperature variable, so it turns out to be insignificant, yeah. When it is included only without, which is not shown here, without temperature variable, so it is negative and significant, but when considered together, so therefore our hypothesis 1 is still valid. A similar finding is for hypothesis 2 when we include also the seasonal affective disorder. So this variable, the effect is not significant, yeah, but our U-shaped relationship continues to be significant in this case, right? Now, as I mentioned, our key explanatory variable is daily temperature level. But of course, it's debatable whether it should be the level or should be actually the trended variable or perhaps changes in the level. So we also use the trended temperature. And the reason is that trend in the temperature may not only be caused by the effects of global warming, but also by, let's say, urbanization, which can lead to local warming due to the heat of buildings and reduced air circulation. And it happens that these weather stations that measure the temperature, yeah, is typically in urbanized, they are close to cities in urbanized areas, right? So we want to isolate this, yeah. And also, as we know, the temperature level, which includes also trends, yeah, entails a slowly moving average, which can be more predictable by sovereign bond investors, and therefore is less likely to cause like changes in sovereign bond holdings. So what we do here is to determine the temperature by computing the moving average over the past 261 trading days in the sample. That's for each country, and that is the average number of trading days in the year. Yeah, and we again use this determined temperature to test hypothesis 1, hypothesis 2, not hypothesis 3, because hypothesis 3 is typically tested with temperature levels, right? So in terms of the determined temperature, we replicate our results, and our results are similar. So there is a positive and linear relationship first between sovereign bond returns and temperature shifts. And that is in line with hypothesis 1. In terms of hypothesis 2, we use deviations of temperature from this moving average of 261 trading days. So we find that beta 2 is positive, but also we find that beta 1 is positive, which means that there is a positive relationship, and this relationship also accelerates for high levels of temperature, or higher upward deviations of temperature from the trend. So to summarize our study, so in terms of hypothesis 1, we find that 10 degrees Fahrenheit increase in the daily temperature raises returns on sovereign bonds by a range between 0.22 and 0.85 basis points. So you probably saw that these values were different in our first table, and the reason is because we consider the whole spectrum of maturities, remember. So that the main line results were for 10-year maturity, which is considered most liquid bonds, but we also consider 2-year, 5-year, 20-year, and 30-year maturities. So it ranges between 0.22 and 0.85. Yeah, the effect is higher for longer maturity bonds. Now, when we consider the quadratic model, so we find that in our baseline models, the positive effect materializes when a certain threshold temperature level is reached. And remember that that threshold temperature ranges according to specification between 25 and 50 Fahrenheit. In terms of degrees Celsius, it's from 3.68 to 10.18 degrees Celsius. So, for instance, when the daily temperature increases by 10 degrees Fahrenheit above the average temperature and the average temperature is 58.58, so then a 10-year sovereign bond return rises by 0.535 basis points. So that's what these figures mean. In terms of the hypothesis 3, we find that hot air temperature shocks positively affect sovereign bond returns, but cold temperature shocks do not translate into an increase in sovereign bond returns. There is a negative relationship here. So this is against the energy demand-based channel. So our results are robust to other considerations. So other considerations, remember, we consider other maturities, 2, 5, 20, and 30 years, and also other specifications, such as we also include the lag-dependent variable in our empirical models in order to, for instance, take into consideration market inefficiencies, non-synchronous trading, and all other reasons of the deviation of sovereign bond returns from fundamentals not related to temperature, of course. In terms of implications and future directions, of course, there is, I think, a lot of opportunities to study the relation between, in general, financial instruments and air temperature and other weather variables. But our research evaluates here short-term temperature effects on sovereign bond returns, and future research can consider also long-term effects. So, for instance, we don't consider whether, and if so, how both government and regulatory responses to climate change are priced in international government bond markets. So, for instance, in terms of environmental regulation, in terms of financial regulations, so what these regulatory responses would mean for the pricing of sovereign bonds. Now, also these short-term gains, if you're a sovereign bond investor, can be reversed if governments decide to either fund or subsidize public investment projects that aim to mitigate or adapt to climate change. So, for instance, in our own research, we find that temperature risk generally generates welfare costs of 93.14% of lifetime utility, which can be offset by subsidizing investment or R&D expenditure. But such subsidies also require borrowing. You probably know that here, for instance, in the UK, so the government has decided to reduce tax. The only way for funding this is to increase borrowing. So borrowing means that public debt levels will rise. That gives rise to high interest rates and affects long-run sovereign bond returns. So these short-term gains can be reversed. And also future research, which can also be informed by general or partial equilibrium models, can seek to shed further light on which of the channels dominates in the nexus between temperature and sovereign bond returns. Yeah. Again, yet another research could consider also risky assets as an alternative to the stock market, or as an alternative to, let's say, a well-diversified portfolio of stocks in your holding. So, for instance, some of the risky assets are more resilient to climate change than others. For instance, biotechnology, diversified consumer services, financial services, healthcare equipment and services, media and entertainment, pharmaceuticals, telecommunication services, yeah, as also highlighted by Pastor Stambo and Taylor in a recent paper in 2022. So investors may choose to rebalance their financial portfolio by increasing exposure to general climate resilient assets. Whatever these assets are, can be climate resilient stocks, it could be bonds, it could be other assets such as, for instance, non-fungible tokens. Yeah, and so that's the literature that I have used, and that's the end of my presentation. I hope it hasn't been too long. Yeah. Thank you so much for listening to me. If there are any questions, so please go ahead.
Thank you very much, Dr. Renatas. My name is Wayanuka. I'm supposed to be the moderator of this session, sessions, but maybe this is a new style for us. Yeah, usually the introduction of speakers usually in the beginning of the session, but I'll make it short. Yeah. This is a new style, you know, we introduced the presenter after the presentation. Sorry. Because
all right, yeah, okay, yeah. So
time
I'm happy to go ahead with that.
That's fine. Before we go to the question and answer sessions, I would like to give some brief description, you know, information, biography information about Dr. Renatas. Yeah. Dr. Renatas Kizis is Associate Professor in Southampton Business School, University of Southampton. He received his BA and MA degrees in economics from the University of Vilnius, Lithuania. And then he received his MSc and PhD in economics from the University of Alicante, Spain. Yeah. And then I think based on the data that I got from the internet as well as from the committee, Dr. Renatas is very productive in publication, over more than 50 publications so far. It's a big number. Yeah. And then he also held visiting academic positions in several countries, including Indonesia. Along with Indonesia is China, Germany, Lithuania, and Spain. Yeah. And then he spent more than 3 years working as an assistant professor at the Technological Institute of Monterrey, Mexico. Yeah, I think that's kind of a brief information about Dr. Renatas. And I think we still have like a possible 5 or 10 minutes for questions and answer. If any questions from the audience? Yeah, Prof. Irwan. Thank you.
Thank you, Bawayan. Hi, Dr. Kizis. Thank you for the presentation. I just would like to make sure, how do you calculate the return? I mean, if the return is positive, does it mean that the bond price increases? Is that what it means?
Yeah, that's correct. Yeah, so it's not bond yield, it's bond return. Yeah,
bond return. Okay, so it
exactly.
means that,
so it's like a capital gain. Yeah.
Okay.
On your bond holding, exactly. So this means that it has increased on the market value. Yes, as a stock return. So typically this is the percentage rate of change from one day to another, because we deal with daily data here.
Okay, what's interesting to me is if that's the case, then when the temperature increases, it seems that the bond yield is lower since the prices increase, right? Is that correct? Am I interpreting that correctly?
Yeah, so we're talking about bond returns again. So there is, as you know, there is this inverse relationship between the bond price and bond yield, and so therefore the bond return and bond yield, if you like, yeah. So you would expect a negative relationship between the two. Yeah.
Yeah. So what's interesting to me is that when the temperature rises, it means it's cheaper for either corporation or government in this case to borrow money from or to issue bonds. Is that correct to interpret that? Because
it in a way that that's the case. Yes.
Okay. So it means that this extremely interpreted means that this climate change will benefit the government when they issue sovereign bonds. They can get a cheaper. They can issue a cheaper, lower yield. Is that correct?
That's one of the takeaways from this study, if you like. Yeah. Now, what is interesting is that government decides to borrow, so hopefully it will borrow in order to invest in infrastructure that is more resilient to global warming and climate change. Yeah. That's the main idea.
Okay. Thank you very much. Interesting paper.
You're welcome. Thank you for your question.
Thank you, Prof. Irwan. There is one more question. Actually, I found this question from the chat box from Lydia. I would like to read it. In this study, does climate change affect all sovereign bonds? Or is there a separation between ordinary sovereign bonds and green sovereign bonds? What do you think about this, Dr. Renata?
Yeah, it's a good question. No, we don't separate between sovereign bonds and green bonds. This could be part of the separate study, and also taking into account that not all probably these countries in the sample have green bonds, so the sample green bonds probably will be much more reduced. Having said that, that would still remain an interesting question going forward, I would say. Does that answer the question?
Okay, hopefully. Yeah, that might be a part of robustness check in the future, or maybe a separate paper. And
exactly.
Yeah, I guess also that sovereign bonds doesn't mean always issued by all government, but it could be by corporate as well. Yeah, it could be possible. Okay, maybe one last question if we still have questions. Is there any other questions from the audience? You may raise your hand or just text your questions in the chat box. Okay, maybe one question from me. You mentioned that the samples that you took in this study comprise this sovereign bonds from developed as well as emerging markets, right? Including Indonesia. Is there any different pattern, if possible? If you find the result or not, maybe. What is the difference between the different pattern between the result of only emerging markets compared to those with developed market? Dr. Renata.
Yeah, it's I guess that's another interesting question. So in all honesty, no, we haven't run this exercise, although we have the means and the tools for doing so. It will be interesting to check this for developed and for emerging market countries. that could be interesting study as a follow-up or as a robustness check as well. So it will also be interesting to study the countries that are northern and southern hemispheres, yeah, particularly because they also have like different, so to say, patterns in terms of this seasonal affective disorder, which I mentioned one of the robustness checks. Yeah, if that affects also sovereign bond investors.
Well, thank you, Dr. Renatas. Thank you for being with us and share a very insightful presentation. This brings a new perspective, to be honest, for me at least. Yeah, by relating the, the return of, or maybe the yield of bonds with a new perspective variable, which is air temperature. Right. It reminds me of something in derivatives area. We call it weather derivative or catastrophic bond or something. It brings new perspective for us, and maybe other scholars from Indonesia. It's not.
It is very much related to weather derivatives here. The weather derivatives, for instance, are very important in agriculture. Yeah. So if you, for instance, like to hedge against future, let's say, disasters, weather disasters, so is one way to proceed is to purchase weather derivatives. But of course, the market needs to be developed, yeah, and so that would provide a hedging tool, yeah. So if that affects future harvests, so that's one way to do it.
Yeah, sure. So again, thank you very much, Dr. Renata. This is only because of limitation of time. Yeah, I think this is the end of the second plenary sessions today. Yeah. Again, thank you very much for sharing with us with new perspective on how to explain what factors actually influence the return of sovereign bonds. And also thank you for Professor Irwan and Lydia for asking questions. I think this is the time for me to back to Miss Santi. Yeah, thank you very much.
Thank you so much for inviting me, and this has been a great opportunity to present at the conference, and I really appreciate it.
Sure, you're welcome. Thank you very much, Dr. Renata. Yeah.
Thank you so much.
Okay, so Dr. Renatas and also Mr. Iwayan, we're going to have a photo session first before we close the session for today. Please position yourself in front of the camera and the committee will take the picture. Wait a moment, please.
Let me get organized probably.
For a great picture. Okay, we're ready on the count of 3. 1, 2, 3. Once again, 1, 2, 3. Once more, 1, 2, 3. Okay. Okay, we're done. Thank you so much, Dr. Renatas and also Mr. Wayan.
Thank you so much.
You. Yeah. 3 times
Bye.
Picture with the same pose. Thank you.
Ladies and gentlemen, we would like to remind you all to please fill the attendance link of each session for today's plenary sessions. In order to get the conference certificate, the link and the QR code will be shown on the screen after the session. So after this, we will have a break first, and then the parallel sessions will start at around 1:30 p.m. and you may go to the room through the link provided. Tomorrow, the plenary session will start at around 9 a.m. in the morning. Thank you so much for your participation and see you next time.
Thank you. Bye-bye.
Thank you, Prof. Irwan. Yeah. Thank you, Mas Leo.
Yeah, thank you, Pak Wayan.
Wayan.
Pak Ted, Pak Anies,
Tapi